Hi, everybody, and welcome to our next edition of GlobalView. I'm joined here today by Elizabeth Rusk, who leads our global economics research practice. And as always, we have lots to talk about, so we'll jump right into the conversation. One of the topics that we've been discussing for a little while with clients has been about rising interest rates in response to the high inflation environment. And a lot of that has been driven by Fed policy. Now, earlier in the year, we put together scenarios that helped us assess what sort of action by the Fed we might expect and how that feeds into our expectations about global growth. We subsequently moved up into our downside scenario as we saw higher sustained inflation in the US and potentially a slightly more hawkish Fed. And we seem to be moving up and up and up into additional downside scenarios as some of the recent actions by the Fed point out too. This is something that we talk to our clients about in the context of course, impact on government cost of credit, the cost of credit that our clients themselves are having to deal with, and of course, the implications across emerging markets, which are having to rapidly follow the Fed in a very challenging environment from an FX perspective. So a lot of it does go back to the Fed. Elizabeth, could you walk us through a little bit kind of how our view has changed, where we stand today, and I guess what would be some of the biggest global implications that companies should think through, whether they have business directly in the US or just in markets that are affected by this rapid tightening of monetary policy?
Yeah, so you're right that this is one of the areas that we've been watching most closely on the global econ side for the last several months, just given the variety of implications carried by Fed policy. So we'll get to that in a minute. But in terms of what we're seeing and how our view has changed recently, prior to the Federal Open Market Committee meeting last Wednesday, so for several weeks prior to that, we were expecting generally hawkish Fed policy for the next several months. And the Fed has delivered on that. For the last several months, the Fed has been raising its benchmark interest rate by 75 basis points at each of its meetings, which was unthinkable just a few months ago and has now become par for the course. At last Wednesday's meeting, there were a few things that happened that has resulted in a bit of a shift in our view, and the shift is even more hawkishness going forward, but with some caveats there. So just to recap what happened last week. So the Federal Reserve raised its benchmark interest rate again by 75 basis points to a new upper bound of 4.0%. Which is the highest it's been now in several years. That was expected by the market, no big surprise there. Everybody kind of knew that would happen, including us. And then there were a few things the Fed said about the policy outlook for the next several months. A couple things were expected there as well. So the Fed indicated that it is likely to slow the degree of rate increases in its next several meetings. So it's probably done with big 75 basis point hikes and will now shift to 25 or 50 basis point hikes. But again, that was kind of expected by the market, so no real news there. A lot of the news coming out of last week's meeting were around several comments that Fed Chair Jerome Powell made about where policy is headed in the next several months and how the Fed sees the current environment. So the Fed indicated that it is still most worried above all about high inflation and sticky inflation, and that it's concerned that inflationary expectations are becoming unanchored. And it also indicated it's more worried about high inflation than about stock prices tanking, house prices tanking, signs of an impending recession. It's still more concerned about inflation. So that tends to indicate the Fed's going to keep hiking, even if we start seeing weaker and weaker economic data. The other thing the Fed said is that even though it's shifting to smaller rate increases, that those increases are likely to continue for longer. So we and markets were expecting that the Fed would stop hiking interest rates in Q1 of next year. But the Fed sent a strong message that because inflation remains quite high and likely will for at least several more months, that it's planning to keep raising interest rates for longer than that, so likely through Q2 as well. As a result, in the end, the Fed is likely to raise its benchmark interest rate well above 5%. So our new base case expectation is that it'll reach a terminal rate of 5.75% in terms of the upper bound. That is way, way higher than what we were expecting several months ago. Our previous expectation was something in the 4% range. So it's been the case for several months now that we are just seeing a more and more hawkish outlook. In terms of the implications, lots of things to draw there. First off, looking at the US, this tends to translate to a weaker economic outlook for the United States. It will weigh on lending, which will weigh on business investment and consumer spending. It also raises various debt risks. It raises the likelihood of financial stress as consumers and businesses and banks, etc., struggle to service existing debt. So that obviously it's likely to lead to a little bit of a downgrade in our growth expectations for the United States. But the global implications are probably even more important in terms of how this is pushing up credit lending rates globally, in terms of how it is pushing other central banks around the world to have to hike their benchmark interest rate. A lot of the reason for that is because when a central bank doesn't hike its benchmark rate, it sees a lot of currency depreciation, and we've seen a lot of that this year already. So in many cases, where a central bank struggles to keep pace with the Fed, we're going to see more depreciation. So this change in view also has changed a little bit of our expectations for FX, where we're likely to see continued dollar strength well into next year as a result. Depends a bit on the currency, but that's sort of the overall trend we're anticipating.
Lots to unpack here, but I'll just summarize a couple of things for senior executives, and then I think we can probably talk about one more interesting topic for this month. This is a totally unprecedented environment for the past 25, 30 years from a global perspective. When executives are putting together plans for next year, of course, this will be one of the inputs there. But I think what this view tells us is that we're not expecting a rapid drop in interest rates anytime next year, really. So this high and rising interest rate environment is likely to characterize a good part of 2023. And so as you're thinking about financial risk within your customer base, risk within any suppliers you might be working with who might suddenly find themselves servicing much higher debt costs, or just being pressured by the currency volatility that this is prompting in a lot of markets. When you think about your distributors and dealers and their ability to carry inventory, make investments, provide credit to customers, especially in the B2B space, all of that has gotten way more expensive than it was previously. And in markets where demand is already weakening, is going to really affect how you think about the economics of your value proposition, the relative cost competitiveness of what you're offering, and the overall cost of doing business. So there's probably a good hour-long conversation we can have with executives about what this means, but I think the main point is this is critically important from a planning perspective, and also will have longer-term implications beyond the things that we're even seeing today in terms of the global economic environment. But there's more risk coming down the pike. And some of that is in commodity markets. So Elizabeth, I know there are a number of deadlines that are approaching in terms of oil in particular when it comes to sanctions and price caps and all sorts of things. And frankly, it's been a little bit confusing. So help those of us who are not fully on top of this understand what is happening, what we should expect to see over the next couple of months, and how all of that might affect energy costs in particular.
Sure. Before getting into the details of what we're expecting to see in the next several weeks, I'll just start off with a general note, which is that we are expecting oil prices to head higher in the next several weeks, just due to all these disruptions that we're anticipating. Our current forecast for Q4 is that Brent crude will average around $100 a barrel. And thus far, it's been averaging in the low 90s. So that indicates an implicit expectation that we're expecting Brent crude prices to go above $100 a barrel in the next several weeks. That's high price environments likely to last into Q1 and will generally be a high oil price environment through next year for a number of reasons. But a lot of this is related to near-term supply disruptions that we're expecting. So to recap all the things that we're seeing and anticipating, December 5th is a big date in oil markets. That is the date when the EU's oil embargo on imports of Russian oil is set to come into place. It's being phased in, so there will be a ban on other petroleum products coming into place in February, but that's when kind of the full ban on crude oil comes into place. We're also expecting a couple of other measures that are likely to be dovetailed with that deadline, although some of the details continue to be ironed out on a day-to-day basis, and it's a little bit difficult to keep up. But the other things we're watching are potential imposition of an oil price cap, approved and led by G7 countries. That's already been kind of approved several weeks ago, but some of the details and are kind of forthcoming, and it hasn't been implemented yet. Another is a ban on European and UK companies insuring ships carrying Russian oil. Now, that's also been watered down in several weeks, and in effect, these are expected to kind of work together. So basically, the idea is there won't be a total ban on insurance of Russian ships carrying Russian oil, but there will be a ban on insurance of ships carrying Russian oil that is being sold above the price cap. So again, this is all very confusing, and that confusion is an issue in itself when it comes to oil supply. Because traders and others are trying to keep up with the rapid change in rules and are having difficulty preparing for some of this disruption coming down the pike. Now, most of this is not going to completely remove a bunch of oil from global supply, at least not immediately, but there will be likely kind of intermediate dislocation that results from this. So for example, the oil embargo, assuming that it works to some degree due to these other enforcement mechanisms and other things, means that potentially up to 1 million barrels per day of Russian crude just has nowhere to go. Some of it will still leak into Europe, some of it will find its way to markets in Asia, but there are physical barriers to doing that in terms of not having ships that are able to carry it due to the insurance ban, not having enough pipelines with capacity to carry oil to Asia and other markets. Eventually, most of this oil will probably leak in and find its way through the system, but we're expecting considerable short to medium term dislocation resulting from this, as well as higher transport costs for oil, which will be reflected in higher oil prices. So this stems from just all sorts of things that continue to happen with respect to the war and war-related spillovers that continue to keep oil and other commodity prices quite elevated. There are other things I could talk about from there, but overall, this kind of points to a general environment of continued high oil prices, even despite the fact that we are expecting weakening demand next year due to recessions in major markets, as well as a continuation of China's zero COVID policy, which is weighing quite a bit on oil prices.
And it also goes back to our previous topic, which is high input costs, continued high input costs contribute to this high inflation environment that is pushing up interest rates around the world. And it's a bit of a vicious cycle, isn't it?
Yeah, to a great extent, a lot of the central bank action that's taken place obviously is intended to bring inflation down, but this series of events and many others in global commodity markets are a reminder that a lot of the inflation we're seeing is stemming from supply shortages and supply risk, and that keeps costs elevated and keeps input cost inflation relatively elevated. So even if you get a recession and take away some demand, which cools price pressures to some extent, if you just don't, if you've got supply shortages, prices are going to remain relatively elevated. So it's proving very, very difficult for central banks to bring inflation down as quickly as they'd like to.
Got it. Great. Well, a lot of food for thought. Thank you very much for the interesting and useful explanations, Elizabeth. This will be all from our GlobalView episode this month. Please join us next month. Looking forward to having you.